So let's get started with Gordon's model, which for many of you, it's a review. We can use Gordon's model with a constant dividend. This is an assumption that dividends stay the same. Or we can have it with a dividend that grows at a constant rate, or we can have it with a variable growth. And also a negative growth is possible. So I'll do an example of each one of these. The only assumption that should not be violated is that this growth rate should not be larger than the cost of capital, and I'll talk about that in a minute too. Our first review problem is something that you have seen before, capital asset pricing model. This model says that cost of capital for Siemens, for example, KS, equals the risk-free rate. The payment on the bonds that US or German government has, depending on the place that we are doing the CAPM model, plus a risk premium for the stock market of that multiplied by beta of Siemens. The simple form of the Gordon formula can be done with the following example. The dividend at time 0 today is $2. There is a constant growth rate, which in a minute we calculate, and that is something that we have done in the past too. And we want to calculate the price of this stock. Gordon formula says P naught, price at time 0, equals to the next period's dividend, D1, divided by KS, cost of capital for equity, minus the growth rate. To get D1, we simply grow D naught at the rate of G. Treating it like an interest rate would be D0 multiplied by 1 plus G, or 2 times 1.06, and D1 is 2.12. And of course, in real life, dividends don't grow like this. So this is an assumption that all the profit or cash flows of the firm are paid out to owners as dividends. So at time 1, the dividend would be $2.12 if it grows at 6%, divided by cost of capital, which is 13%, and we write it as 0.13, minus 0.06, or 6% growth rate. One way to remember this formula is that if cost of capital is 13%, 6% of it is paid to us by the growth of this company, and the other 7% is used for discounting the cash flows. And this gives us a $30.29 value for this share of stock. And of course, if we want to value the firm, we multiply this by number of shares, and then we add the value of debt to it. Gordon formula can be used at any time on our timeline. So let's use it at time 1 period from now, say 1 year from now. Next year, the estimated stock price P1 hat would be dividend at next period after that, which would be D2, or dividends 2 years from now, divided by same terms that we had before, KS minus G. So in this case, we multiply D1 by 1.06 again, and we get 2.247 if dividends grew by 6% for 2 years. And we divide this by same 0.10 minus 0.06, and we get $32.10. And of course, this implies that the stock price grows at the rate of 6%, the same rate as G. Sort of a not so funny joke is that at this growth rate, every cash flow, every sales, every revenue, and the stock price grows. And the joke is the management gets fatter at this rate too. So growth rate applies to all the accounting data that we have. So we could simply take the price of the stock at time 0 and multiply it by 1.06 and get the same estimated result for the stock price at time one, P1 hat equals $32.10. We could also calculate dividend yield. And this would be dividends that we are paid next period, D1, $2.12, divided by how much we invest if we pay and purchase this share at the price P0, which is $30.29. And that gives us 0.07 or 7% dividend yield. That means this stock pays us 7% of our money as dividends, and it also pays us capital gains because the stock grows. We know this capital gain is going to be 6% because, as I said before in that joke, everything grows by 6%, and this stock grows by 6% in price. But if we were to calculate it in a CFA problem, we calculate capital gains by saying price at time one minus price at time zero divided by how much we pay to purchase the stock at time zero. 32.10 minus 30.29 divided by 30.29 or 0.06 or 6%. Total return is, of course, capital gains return plus dividend return. So this stock is paying us 13%. Putting this on a timeline, we go to a problem when the growth rate is zero. Simply, we put 0 for G in Gordon's formula, and that becomes a perpetuity formula. The stock is paying us $2 every period forever, and cost of capital is 13%. So the perpetuity formula says this share is worth at time zero $2 divided by cost of capital, or 0.13 or $15.38 if the stock did not grow at all. Then we go to variable growth. This is for a startup company or a company that is in its growth stage, and a company does not grow forever. They go through a life cycle. Growth stages could be 3 to 5 years or something like that. So in this case, after some period of growth, the firm becomes mature like Microsoft, and they would have a constant growth rate of 6% in this example. And growth rates usually are under 6% for companies. Same goes for industrialized nations of the world. Germany or US will not grow by 10%, but China can because it's a developing nation. Same with mature companies, growth rates are usually under 6%. Here is an example of variable growth rate. On this timeline, cost of capital, KS, is 13%. The firm has a dividend of $2 at time zero, and then it grows at a rate of 30% for 3 years. So I have G equal 30% under time 1, 2, and 3. And then after that, it grows at a constant rate of 6%, which I have it at after 3 years. Now we park the Gordon's formula under year 3. Remember that Gordon's formula works at any year. But if we park it under year 3, it would say the estimated stock price at year 3 is the dividends at year 4 divided by same denominator that we had before, KS minus G. So we need to have D4 to input into this Gordon's formula. To calculate D4, we take the $2 at time zero and grow it by 30%, multiplied by 1.3, and we get $2.60. Then we grow it again at 30%, 2.6 multiplied by 1.3, and we get $3.38. Then we grow it from year 2 to year 3 by 30%, multiplying it by 1.3, we get 4.394%. After this, the growth becomes constant, 6%. So we grow this $4.39, multiplying it by 1.06, and we say the estimated dividends at year 4 are $4.65. So now we have our inputs for Gordon formula sitting at year 3. P3 hat estimated, a stock price is estimated using Gordon formula to be 4.68 dividends at time 4 divided by cost of capital of 13% or 0.13 minus 0.06, which is the growth rate. This gives us a stock price of $66.54 after 3 years. We have to discount this future value and bring it to present. Because it's 3 years in the future, we divide this 66.54 by 1.13 for 13% cost of capital raised to power 3 or discounting for 3 years. A common mistake in the exam is to use the 6% growth rate or 30% growth rate as cost of capital. No, cost of capital is always 13% in entire timeline. So this 66.54 comes to present and becomes $46.114. Now we have to discount every cash flow that appears before this time. Gordon's formula have calculated the value of a stock at time 3, but at time 3 we have a cash flow, a dividend of $4.39 that the previous owner of the stock receives, and we bring that back 3 years too, and that is worth 4.39 divided by 1.13 raised to power 3, and that would be $3.045. And then at year 2, we have a dividend of $3.38. Discounting the 2 years, it becomes $2.64. And finally, at year 1, we have a dividend of 2.6, and discounting it a year, dividing it by 1.13 becomes 2.3. Now we go and add this cash flows at time 0. And here we have to consider if we have a post-dividend calculation or pre-dividend calculation. Post-dividend means that the dividend is paid to the owner before she or he sold us the stock. So we are not getting that $2. Someone else got it and then sold us the stock. This problem says do a post-dividend calculation. If the problem in CFA said do an ex-dividend calculation, it means the dividends are not paid yet, so you add the $2 with the other cash flows. This is post-dividend, so we add 2.3 plus 2.6 plus 3.04 plus 46.11, and we get 54.107 as the estimated stock price at time 0. $54. Then we're calculating expected dividend and capital gain yields during first and fourth years. Notice that the problem says expected because this is calculations for future. These dividends are not paid yet. So dividend yield for the first year is $2.60. Going back to the timeline, you see that at year 1 we get $2.60 of dividend, and that should be divided by the stock price at time 0, which would be our current investment to receive that dividend, and that's the $54.10 that we estimated at the bottom of slide 11. And that would give us 4.81% dividend yield. It says capital gain yields should be calculated for the first year. And this would be 13% that is cost of capital and 4.81%, which is dividend yield. Notice that the stock in equilibrium would always pay us cost of capital, and we got some of this payment as a dividend yield, and the rest of it comes as capital gain. So we go 13 minus 4.81%. All right, let's go to the next problem. And the next problem says the growth is 0 for a few years, and then we go to a constant growth rate. So it's very familiar to us. It's the same timeline, except with a growth of 0, we keep the dividends as $2 for 3 years, and after that we raise them by 6% to $2.12. We park Gordon's formula at year 3 and calculate it with D4 of $2.12 divided by 7% or 0.07, and we get $30.29 value for this stock. Then we discount all these cash flows, and because this is again a dividend at time 0 that goes to previous owner, we add up the numbers that we have there and we get $25.72. For comparisons, see that the stock price have gone half if the firm doesn't grow for 3 years. Now we are calculating dividend yield. The calculations are pretty much the same as before, and that's the dividend divided by the price or value of this stock, which in equilibrium it's what we should pay to purchase the stock, and that comes to 7.78%, and we deduct that from 13% cost of capital, saying that basically capital gain equals to cost of capital in equilibrium, and we get 5.22% as capital gain because 7.78% of our gain is paid to us as dividends. We go to the next problem, and this one is interesting. Can the growth rate be negative? Yeah, this is for a firm that is imploding. It's at the last stage of its life cycle, and let's say our growth rate is minus 6%. We simply put minus 6% in the Gordon's formula. So we have the same formula as before. We have to calculate KS minus growth rate of 6%. This would be 0.13 cost of capital, hasn't changed for this firm, minus 0.6, which becomes plus, minus becomes plus, and we get 19% in the denominator, or 0.19. The denominator is also different because the $2 dividend is also assumed to shrink at the growth rate of this company, which is negative. So we multiply 2 by 1 minus 0.06. So that would be 0.94. So we expect the next dividend to be $1.88. Divided by 0.19, we get $9.89 as the value of this company. And you see that the company that has negative growth, its value dramatically drops. We could also calculate capital gain and dividend yield, and this is a common CFA question, and here the values are actually misplaced. So this should be dividend gain. This should be dividend gain, and the other one should be capital gains. I will correct this later on. There's a typo in this slide. Going to the next slide, we have a general formula for dividend growth model, and that's basically there for review, and those of you who would like to have it as a formula. But I think putting numbers the way we did is much easier for remembering it. And finally, the assumption, the growth rate G cannot be more than cost of capital. Simply mathematically, this Gordon formula breaks down if growth rate is more than KS. Then we go to corporate value model. As you can imagine, many companies have dividend smoothing. It means they keep their dividends the same every year, even if they have to borrow money and pay dividends. So this assumption that dividend grows at the growth rate of the company is sort of a sour assumption when we go to the industry. To make it more practical, we can look at cash flows and discount cash flows using the same Gordon model. To calculate cash flow, you look at the bottom of the income statement and you get the net income. And then you add to this net income the depreciation, because depreciation is a non-cash cost, a cost that we deducted. Government allowed us to do that in order to pay less taxes, but we have not paid out of our pocket this year for a machine that got older and depreciated. That cost was paid when we purchased the machine. A better way of doing the cash flows is to deal with free cash flows. One way of dealing with free cash flows is, after getting the cash flow, we deduct the investments that the firm has committed to make. And investments could either be read from the data providers, or you could look at basically fixed assets of the firm next year and subtract the fixed assets this year, and saying the company had gone shopping and bought these fixed assets, more factories, more machineries. So one way of getting free cash flow is to subtract investment and add depreciation to net income. A better way of doing this is to deal with NOPAT. NOPAT is net operating capital after taxes. And this means that we don't deduct interest when we are in the income statement. Before we deduct interest, we pay taxes. Of course, this is not the way we pay taxes, but here we are doing this, so then we pay cost of capital for both debt and equity. Okay, here is an example of calculating a value of a firm based on cash flows. Here we have the 3-year cash flows of a firm, and cash flows are given as 5 million, let's say, euros. After 1 year, we purchased the company, the factory, at 5 million euros. Then year 2, the free cash flow is 10 million euros. You could imagine or pretend that this factory is a cash machine and it spits out 10 million euros. At year 3, we get 20 million euros. And then after that, these 3 cash flows are estimated from pro forma accounting statements. These are forecasted accounting statements, and the company provides them. We could take this income statement as a goal, and because we keep the foot of the managers to the fire if they don't achieve these goals, they tend to be conservative and not brag too much at having an income statement for the future that is not achievable. So we trust these future income statements. But like forecasting the weather, you can forecast it for a couple of periods. Here for 3 years, it's forecasted. And if someone asks you what's the weather in July 20 in Germany, then we just go to average temperature and average weather of Germany over the years at that time. And here we go to a growth rate. And of course, we have a way to calculate growth rate, which I will review in a minute. So for 3 years, we could comfortably forecast our cash flows from pro forma accounting statements. And after that, we are forecasting a growth rate of 6% based on the retained earning the company has and return on equity that it has. And this 6% is assumed to remain constant. Now again, we go and park Gordon's formula under year 3. Not everything could be written under year 3, but the final answer, 530, is under year 3 in this timeline. So this Gordon formula says the value of this firm in millions of euros equals to the cash flow at year 4. Remember that with the dividends too, Gordon formula always looks at one period ahead. So that cash flow a year later is the same 20 that we have at year 3 that was given to us from the free cash flow that we got from pro forma accounting statements, and that grows by 6%. So 20 multiplied by this fixed growth rate that we can also calculate, and I will do in a minute, would be 20 times 1.06, and we are assuming that the factory spits out 21 million point two as cash next period, and this growth continues every year. This 21.2 goes at the nominator of the Gordon's formula. It gets divided by cost of capital, which comes from CAPM and is based on riskiness and beta of this company in that one factor model. And here it's given as 10%. And we are subtracting the growth rate of 6%, and we call this thing a TV, or terminal value. And this happens at time 3, so TV3. And this calculation gives us 530 million that sits at year 3. And the intuition behind this is that after 3 years, this factory, this business would be worth 530 million euros based on our estimate, if it grows at the rate of 6%. Then we got to discount this 530, now at the cost of capital, dividing it by 1.1 raised to power 3, and it becomes 398 million and some change. Then we discount the 20 million cash flow at year 3 and bring it back 3 years, and it becomes 15 million. Discount the 10 million at year 2, and it becomes 8 million. And discount the 5 million that we paid to purchase the factory at year 1, and it becomes minus 4.5 million in today's money. Adding this up, we get 416.94 million as the value that comes from corporate value model. This is the value of the equity. If the above firm has, this is the value of the company. Corporate value model gives us the value, a total value of debt and equity for the value of the company. If this firm has 40 million debt on its capital structure and it has 10 million shares of stock, what is the firm's intrinsic value per share? Again, here we are doing a stock valuation and telling people to purchase this stock. But by intrinsic value, we mean a value that we assign based on our valuation or our calculation to this firm, but the stock price could be more than this, and then we say don't buy this stock. Or the stock price could be cheaper than this, and we give a buy order. So intrinsic value becomes this very easy formula that comes often useful in accounting and finance. Total value is value of debt plus value of equity. V equals D plus E. So here the value of equity is the total value or the firm value minus value of debt. We calculated or estimated the firm value as 416 million and 94 minus 40 million value of debt that is given to us here. And of course, we could, if we are working with accounting data, we could read off the balance sheet what the value of the debt is. And if we are looking at market value estimation, we can calculate this from the value of bonds. And we did this 2 lectures ago. And this gives a value of equity of 376.94 million. Because there are 10 million shares, dividing this value to get a per share price, we say a share of a stock is 37.69. I worked with euros and I have a dollar sign there, but either way it works. Let's continue. Basically, this what we did with an example is written as a formula here. What are the issues with this model? Often we prefer this corporate value model, especially on a practical basis over the Gordon's formula applied to the stock price. It makes more sense practically, and then when the data comes from the accounting statement, it gives us a better valuation formula. But the modeling and technique is very similar to what Professor Gordon did with his dividend discount model. And this terminal value really represents how much the firm is worth at time N, which was 3 years now. There are some questions that directly address these lectures, and they were in past CFA exams, and I have peppered the lectures with these questions. When you read this lecture, you can go over those questions, and the answers are there with an explanation. But we do a mock exam next week, and a lot more questions will come your way. A formula for dividend discount model. And a formula for free cash flow, or basically the model we just used, corporate value model. Next, we go to preferred stock valuation. Preferred stocks generally do not participate in the growth of the company, so they don't get that G. Essentially, they get a dividend, and dividend is often fixed and written in their certificate. So it becomes a calculation based on the perpetuity formula, which we have seen before. And here is a question from old CFA exams, and go over it, and it gives you a calculation using perpetuity formula and gives you an answer. More examples here. That gets us to calculation of G. To estimate the growth, we say a company makes profit, and that profit is at the bottom of income statement. Some of the profit company keeps, let's say it keeps 40% of the company, of the profit in the company. We are assuming that this money is not wasted. We buy more factory and machines with it, and we expand our business. So if we keep 40% of the profit, our retention rate of profit is 0.4, and this 0.4 contributes to growth. And we assume that we generate the same sort of profit, accounting profit, that we did last period. That is return on equity. Anytime you see return, that's profit divided by what you see after it. Here is equity. So we get the total equity from balance sheet, and that goes in the denominator, and we get the profit or net income from the bottom of income statement, and we divide these two by each other, and we get return on equity, and we multiply that by the retention rate. A retention rate is also called plowback ratio. That word comes from farming. We are plowing the seeds back into our activity or our farm, expanding the business. There are more examples here to work with answers. I'll go over this quickly. They are repetition of what we have done with questions from past CFA exams. And I want to jump to a stock, to a slide 80 something, which starts with terminology now. Stock 81. About half the questions that CFA has about equities is definitions. What stocks mean, how do they work, what preferred stocks mean, and so forth. Definition of common stock, obviously this is a share of ownership in a public company. As a stockholder, you are the owner of the firm, but this is dispersed ownership. Most companies target €100 or $100 price. When their price goes much higher, they split this stock. And so a 400 euro stock split it by 4 becomes 4 stocks of €100. And splitting the stock also conveys information that insiders have in asymmetric information world and outsiders don't. And that information is that we're confident that our firm will have income and will not go to low stock prices. Therefore, we are splitting these shares. So 400 stock may go to 101 when you split it in 4, and that extra €1 is because of the signaling theory, the management signaling to you that they are able to grow this firm and they are confident that they have growth potential. Ownership implies control. That imply is something we should put in red and focus on, because there is separation of ownership and control. Professional managers control a public corporation, and stockholders who are dispersed, who may have a few shares, are the owners. Therefore, the managers could take advantage of shareholders. We call that agency theory, and there is agency cost. For example, the manager can buy a jet airplane, but the stockholder pays for it. And to solve this problem, we often give the manager stock options. So if they increase the stock price, these options allow them to purchase the stock at a price that is exercise price of that option. And this provides a motivation, financial motivation, for manager to work hard and bring the stock price up to that level. The stockholders elect the directors, and directors elect the management. This is part of corporate governance issues. There are very few cases where actually these directors have fired the manager. Usually it happens when the corporation faces bankruptcy. The only case that I remember that in good economic times a manager was fired was Eastern Airlines in US, and this was a manager who was very abrasive and had all kinds of problems with the workers. The management goal is to maximize the stock price, not to maximize profit, because we can maximize profit or net income by increasing the risk of the corporation. And there is a good case study where we look at Porsche doing high risk and raising its, getting into derivatives and raising its risk, and also raising its return. And this essentially was because the Porsche's managers' pay was tied to profit, not to a stock price. Preferred stock. This is a hybrid security. By hybrid, we mean it's neither debt nor equity. It's somewhere in between. Preferred stocks look like equity in the sense that if they don't pay dividends, they are not in default and we can't drag them to bankruptcy court. Preferred stocks look like debt because the certificate would tell us what is the promised dividend. For example, 5% Siemens preferred, and we usually call them by that percentage that they promise. This usually has some consequences if the firm doesn't pay the 5%, and usually firms pay it. preferred stockholders do not participate in the growth of the firm. So if you were a preferred stockholder in Microsoft when it was a little company, you would just get something in line with an interest rate that debt gets. But if you were a stockholder a long time ago in Microsoft, now you're a multimillionaire. So in the sense that you receive a fixed income, preferred stocks are very much like debt, very much like bonds. What is a floating rate preferred? The dividends of this preferred stock changes over time. Usually it is tied to a government security if it's in US, to a treasury security, plus some additional amount on top of it. So these dividends actually change over time. This is pretty much to allow you to be compensated for inflation or other changes in the company. Again, preferred dividends are fixed, but sometimes they are cumulative. Cumulative means that all the past dividends that are not paid have to be added and be paid. Most preferred stocks also prohibit the firm from paying common dividends if they don't pay preferred stock dividends first. So these are consequences that make preferred stocks more like debt, even though the firm is not in default if it doesn't pay dividends to preferred stocks, but it has all kinds of incentive to pay it, and most firms pay the dividend on preferred stocks, and therefore these dividends start looking a lot like interest on debt. As I said before, we can look at preferred stocks as a perpetuity and value them that way. And here is another example of it. Then we want to look at the definition of primary markets and secondary markets. Most of the stocks that are traded in New York Stock Exchange or in Frankfurt are traded in the secondary market. Secondary market means that I sell a stock and then someone else that I don't know is purchasing this stock. So these two sides basically going through intermediary in the market and selling the stock to each other. To put this more dramatically, if you pay 100 euros and purchase a share of Siemens, Siemens does not get your 100 euro, does not get to buy machines, and you use your 100 euro equity capital as capital that goes to Siemens. You are in the secondary market. And then the question is, well, what's the use of the stock market if it doesn't take capital from savers and gives it to the companies? Well, in an initial public offering, the first time that a private company raises capital in the stock market through investment bankers, that capital is used, or at least some of it is used for growth of the company. Some of it may go to the private owners of this company and they may cash out. But those initial public offerings are usually done in smaller markets. For example, over the counter with dealers through the phone lines and computers connected to each other, like NASDAQ. Not on the main stock exchange like New York Stock Exchange. If they ask you to define dividends, you say dividends are periodic cash distribution. They are similar to interest payment, but dividends go to equity. Interest payment goes to bondholders and goes to debt. Interest payment is mandatory. If we don't pay it, we are in default and they take us to bankruptcy. Dividend payments are at the discretion of the firm, but most firms pay it and keep it constant. Price earning ratio is price per share of dividend, how much of the um, is price divided by earning of the company. We go to the bottom of income statement and we divide it price per PE ratio. We go to price of the dividend and we look at earning per share. So we go to the income statement and divide that net income by number of shares and we get basically earning per share, and then we get the stock price and divide it by earning per share. And we should also make a distinction between book value and market value. Book value is based on our accounting calculation. Essentially, you can get the book value of the firm by looking at the bottom of the balance sheet. That's the value of debt plus the value of equity that they have, or that's the value of all their assets from the other side of the balance sheet. Market value is market capitalization of the firm, and you basically get this by getting a share of a stock and multiplying it by number of stocks, and that would be total value of equity in the marketplace. That changes every minute that the marketplace is open, and then you add the value of the debt, and again you can get it from the marketplace with a proxy. We usually look at the 15-year debt and proxy it for the value of debt, and then we go to debt equity ratio and figure out how much debt the firm has and what's the value of this debt. Liquidation value is net proceeds that we would get if we sell the assets of the firm piece by piece. So a number of definitions here. And here is an ethical question. We said that a stock price maximization should be the goal of the corporation. Should the corporation worry about the workers, the customers, the suppliers, the public, making the environment dirty? So basically, does ethics play a role, have a role in this stock price maximization? One answer in our free market economy is that the other considerations should come as constraints. So, for example, take the workers. If the workers are allowed to have a union, and if that union can strike and has essentially a way to get their fair share, then they put a constraint on the company. If we are allowed to exert pressure and form an environmental protection group and force the firm to do this right thing in terms of not polluting the environment, then that's a constraint on their operation. But the goal should be profit maximization. So if you look at the old operation research and linear programming, mathematically it tells us you could have an objective function which is maximize profit, but we don't say maximize profit, we say maximize stock value. And then we say it's subject to a number of constraints that each stakeholder puts on the firm. And the old mathematical argument was that you can't have two objective functions. You would get less production, less efficiency that way. And of course, this also depends on your politics, but this is the sort of free market argument. The corporate governance in US is closest to this sort of argument, but it's not exactly it. The corporate governance in Germany is a bit different. because workers are in the board, so they are privy to all the decisions that the board makes. So they are part of corporate governance. So this maximizing the stock price is really together with maximizing workers' interest. It's not just a constraint; they are part of the decision making. I talked about primary markets and secondary markets, and this IPO, initial public offering, or going public when a firm is sold to general public. And generally, IPOs are underpriced, means you can make additional return by buying IPOs, but they tend to go to clients that are well known and have a relationship with the brokers. There are additional questions here that you can look at as you go over these. In terms of risk, equity is always the highest risk instrument. So you might say, what about junk bonds? The word junk means this bond is not investment quality, it's high risk. Well, the junk bond of a corporation is also less risky than the stock of that corporation, not the stock of another corporation. The reason for that is that equity holders are residual claimants. The word residual means you eat leftover. So imagine there is a pot of food that you're producing. Everybody gets paid from that pot. Everybody gets to eat from that pot. Then in back of your mind, go to the income statement and say variable cost or COGS is paid first. Then fixed cost is paid. Then we go down and pay every stakeholder. We pay for depreciation and amortization. We pay interest and debt. We pay taxes to government. And then we come to the profit. And then this profit belongs to, or this net income belongs to stockholders. So in effect, if there is nothing left, stockholders get nothing, but debt holders get paid first. So equity is always higher risk than debt. Some statistics that is useful in a CFA exam. On average, the equities or stocks of various companies all around the world pay about 5% over the years. And this is after adjusting for inflation. If you look at industrialized nations of the world and you adjust for inflation, the pay on debt is 1% or less. For Germany, for US, this gets very close to zero. So there you have an investment advice too. If you want your money to grow for retirement, it's better to invest in stocks than to invest to loan the money. Usually after paying for inflation, you don't make much. There is also a very famous puzzle, and that is called equity premium puzzle. It means the stocks pay more than their risk, more than is justified by their risk. And this applies to most countries of the world, in the industrialized nations of the world. So again, there is quite a few reasons to invest in the stocks. After all, the stocks produce. And these are firms that shoulder risk and produce. If we loan our money to the government, it's basically used for various costs that government has. But we know that stocks are risky, and some of the worst declines in the stock market have been half the price being wiped out in a day or in a short period of time. So we can lose our investment if we invest in stocks. The bonds of German government, US government can be interpreted as risk-free. Nothing in this world is risk-free, but to a large extent, we can be sure that German government pays us, and U.S. government had paid for 200 years, never gone to default or bankruptcy on its debt. In fact, we need some safe instrument for our financial operations. That's why even at the times where Germany had no need for borrowing because essentially it had more income from taxation and other sources than it was paying out, it would still issue some debt because that debt is needed for sort of financial health of the economy. Unfortunately, we don't have those times anymore, and German government, the same as U.S. government, needs to borrow and has a shortfall in its financing. The U.S. has the largest equity market. It's roughly 20% of the world's gross domestic product, and 43% of the world's equity is traded in the U.S. equity market. Emerging markets are about 44% of the world's GDP and 11% of the world's equity market. Another statistic to keep in mind, and sometimes I've seen it in CFA exams, is that the value of the world's equity is about 100% of the value of the world's gross domestic product. And this statistic was from 2008, but if you go over other years and average, the average is about 50%. More questions to look at? Cumulative voting is interesting, another area where we have definitions that we may not have seen in our normal studies. And this is a feature that some stock markets have, and this is to help the minority shareholders. This basically says that if you don't have cumulative voting and there are, let's say, 4 different individuals that you are voting for to go to the board of directors, you have 1 vote for each. But if you have cumulative voting, you could take all your 4 votes and give it to 1 individual. So this allows a person who may have 5% of the stock to have 20% of the votes when we have cumulative voting for 4 different slots on the board, and be very influential and take their own person on the board. There are all kinds of studies that says that firms that have minority shareholders that have a large percentage of shares, 5%, 6%, maybe instead of the word large, we should say significant. 5% is significant, 6% is significant. You and I may have a share, and that would be an insignificant part of the value of the firm, worth 100 euros. But someone who has 5% of the shares, that someone usually affects the value of the firm. Because their holding of this company is into millions, they tend to invest money and monitor the firm, and they tend to complain when the firm doesn't do the right thing. If the firm buys that jet airplane and it's not justified and is at the cost of shareholders, then these people may take newspaper ads, may even cooperate with takeover attempts, and all of that makes minority shareholders important. There are some minority shareholders that are famous for being active and making corporations have better corporate governance. For example, CalPERS, which is California Retirement Account, is known as a very aggressive and sort of active investor in many firms by holding a minority share there and basically complaining very loudly if the corporation does the wrong thing. Preferred shares have no maturity. Remember that in the equations, we looked at as a perpetuity. Maturity usually goes with the debt. For example, we have a 10-year bond. The bond matures after 10 years. They give our money back. Preferred shares usually have no voting rights. They usually don't make abnormal returns, something that I talked about before. If you had preferred shares in Microsoft a long time ago, you won't be a multi-millionaire, but with normal shares, you would have been a multi-millionaire. But preferred shares are treated bankruptcy. When a company is in bankruptcy court, usually the rules are that debt holders should get the assets of the firm. But the judge kind of looks at workers' interest and says, well, let's pay 10 cents on the dollar to bondholders, debt holders, and let this company operate like GM post bankruptcy. And then the company can prosper and the workers can, some of them, keep their jobs, and the debt does not get their full value. But debt always has seniority over stocks. And then when you go to preferred stock has seniority over common stock. Seniority means that judge usually pays these preferred stockholders first and pays them more than she or he pays to the common stockholders. As I said before, with some preferred stocks, you have to pay all the past dividends, and we call those cumulative preferred. And if all the unpaid dividends are not paid on cumulative preferred, the company cannot pay the common shares. And there is another kind of preferred share that is called participating preferred. This one looks a lot more like stocks, and they are often given to venture capitalists and people who invest in companies at their growth stage. Participating preferred means this preferred share gets to participate in some of the firm's growth, not all of it. And in bankruptcy, the judges value this participating preferred more than the interest that is written on them, because you are also participating in the growth of the firm like a stockholder. Then we have convertible preferred stock. This word convertible, we use it with cars too, when it's used with stocks or bonds, means you can change them to something else. So when you have convertible preferred stock, you can convert them to common stocks. Again, these are used with companies that have high growth or startup companies that don't generate a lot of income now, but they want to get capital from venture capitalists, and the venture capitalists say, well, later on, if the company is successful, well, I know 1 out of 100 of these ventures become successful, but if your company is successful, I want to be shareholder. So they convert their preferred shares to common shares, and they become partial owner of the firm. Of course, this can only be done if the shares are defined as convertible preferred stocks. This makes these shares less risky because they have the riskiness of the preferred stocks, which is lower than the riskiness of common stocks. But once the uncertainty is settled and the stock is valued more, we can convert them and make them to common stock with the same risk as common stock. Then there is this concept of callable and putable shares. This goes to call and put option. Callable shares means the company could pay you off and purchase the shares back from you. And if the company retains this option, you lose the value of this option, or when the stock becomes very valuable, the company can purchase it and you don't participate in additional growth. So this makes the stock cheaper. Putable shares are more expensive. And this means that the company says that the value of your share will never go lower than a certain amount. And when it gets to there, you can sell the share to the company. For example, you can have a put on the putable share at 50 euros. The stock is 100 now, but if it goes to 40, you give the shares back to the company and get 50. There are some questions on this that you could review, and of course they will come in our exam that we have next time. Then we get to the definition of private equity. As the word implies, this ownership is not public. Stocks were public ownership. Private equity comes from a private group, usually money managers, and they purchase a part of the firm. Often private equity attempts to buy a firm that has problems, buy them out, and get rid of those problems, do change management, increase the value of the firm, and then harvest them, sell them out. And for that reason, private equity also has some black eye and bad reputation among workers because the efficiency measures that they put in place could involve firing some of the workforce or forcing the companies to sort of be more aggressive with customers and other stakeholders. But the main idea behind private equity is to make a firm more efficient and then harvest it. What is the advantage of private equity? Essentially, if we take a company private, a lot of requirements that the exchange puts on our shoulder and some requirements that government has for the stock public companies would be relaxed, and private companies don't have that. This is similar to a private company in Germany, for example, Herr Schwarz company. They don't really have to give us their accounting statements. They don't have to make it public. They don't have to tell us what their profit is. But if we have a public company, this information has to be transparent. So there are less reporting required from public equity. Public equity usually has a long-term investment horizon, means these people stick their money in the firm and keep it for several years and don't harvest. And this long-term horizon allows the management to also have long-term horizon and not be focused on short-term efficiency and short-term profit. Disadvantage, they are less liquid. For example, if we want to sell a share of a stock, we just call our broker and sell it. Let's say we are in France and we want to sell a block of the shares that belongs to a private equity. This usually go to the upstairs market and it's placed with some rich individuals or money managers and gets a different price, and it's harder to place. Therefore, ability to raise capital for firms that are private and have private equity is lower. It's easier to issue bonds and issue stocks if we are a public company. Private equity can be characterized as venture capital. If CFA asks you what's venture capital, the word venture means we provide financing to startups. There is a TV program in Germany that looks at the startups and kind of gives you an idea of them. Leverage buyout, or LBO, if they ask you to define that, usually these companies use debt and purchase a public company and take it private. If this is done by the current management of the company, we call it MBO, management buyout. The managers buy the company from the public, buy the stocks, basically by issuing debt. Sometimes these buyouts force the firm to go to bankruptcy because too much debt is put on its shoulder. PIPE is also something that may come in the exam. This is private investment in a public company. And essentially, when we were talking about the upstairs market of the French bourse, they usually do these pipes. They find a private individual to invest and buy a chunk of a company or a block of the shares. There are additional questions that address these issues, and they are in lecture notes. And of course, these would also be in our mock exam. These are all CFA questions. Then we go to investing in foreign equity. And this investment usually diversifies your portfolio. So many money managers look into it. But the problem is that across the borders, we would face less liquidity, and we may also have transaction risk because these stocks in other stock markets are in foreign currencies, and the value of that foreign currency may fluctuate dramatically against the value of our currency. Some countries have less transparency. For example, the stock market in, let's say, Uzbekistan is not as transparent, or the stock market in India is not as transparent as the stock market in US or in Germany. And the exchange regulation and procedures are different, perhaps less trustworthy in developing nations. To make these investments easier, we have depository receipts. For depository receipts, a money manager deposits the shares of these foreign companies in a bank, and then claims to these deposit shares or deposit receipts are sold or traded on a stock market. This makes it a easier way to invest in foreign markets. Sometimes the companies themselves are involved in depositing their shares in a bank and offering it in a foreign country, and we call that sponsored depository receipts. And sometimes the company is not involved at all. Some intermediary, some investor buys their shares and deposits in the bank and offers it in a foreign country. Let me stop the lecture at this point and go to internet and see if you guys have any questions, any comments, anything I can help with. Questions? Can you guys still hear me? I don't have any messages, so that's good. And I have no questions. this far, right? Any questions from the class? Let me leave it at this. There is a mock exam on this stuff next time, and then the questions will be posted, the answers will be posted on internet. The answers to the last quiz with a lot of other questions and a lot of other answers are already on Elias, and you guys can download it. Take care. Bye-bye. Dankeschön.
Bye bye.